The burdens of high inflation fall heaviest on those who are least able to bear them. Restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation.
Now, markets are reacting, of course, negatively to Fed Chair Powell's hawkish stance during the Jackson Hole remark, as you just heard, with the Dow ending the day down over 1,000 points. And technology was the hardest hit sector. The major averages now, by the way, down over 4% for the week. And now the question for investors is, what happens to stocks if and when rates stabilize?
Welcome back, you legends. I'm Dr. Khan. Let's get right into this video. So what the heck happened on Friday? Well, the stock market had its worst day since June for the S&P and its worst day since May for the Dow Jones. This was a monumental sell-off. The S&P down more than 3%, the Nasdaq knocking on the door of 4%, and the Dow more than 3%. In fact, every single sector closed in the red on Friday, but if we look at the weekly performance, we actually had energy and basic materials. So inflationary sectors went up, everything else declined. Same thing here, guys. If we take a look at the weekly stock market map, clearly energy and some basic material stocks, including copper, were the clear standouts. Everything else saw massive losses. Microsoft down more than 6% in a single week. Google, Amazon down more than 5%. Nvidia, the darling of the semiconductor sector, down nearly 9%. So it was a really rough day for stocks. But why did the stock market crash? Apparently, out of nowhere, all of a sudden. Was it really a surprise? Really, the answer is one word: greed. Greed is why the stock market crashed. And here's why. Do you guys remember this article? I did talk about this article 2 weeks ago. Loosening financial conditions threaten central bank inflation fight. Now, I've been warning guys for weeks that a stock market crash was coming right off the heels of Jackson Hole. In fact, look at this. 11 days ago, Fed wants to crash stocks to make you feel poor. Mark the state about to get ugly. The next day, stock crash coming. Many indicators warn. Fed playing a dangerous game next week. A day later, so many signs warn a crash is imminent. Air quotes, legal manipulation to make you poor. One day later, I talked about the most significant predictor of recessions and major crashes with a 100% track record going back more than 100 years. One day later, we started to see the market sell off on Monday right over here, and that was the beginning of the sell-off. The next couple of days, I started to talk about this, guys, this little move to the upside. We saw it coming. We started to talk about it. Thanks to little hints from the bond market, we saw this bounce back up coming. And right here, just 2 days before the market crashed, one last rally to trap bulls before the next big crash. Do not be fooled. Now, admittedly, guys, I do have to admit that I expected one last push to the upside just to trap more bulls in. I've been watching the markets for over 8 years, guys, and one of the many conclusions that I came to was that the market is evil. Okay, you have to come at it from the perspective of the market is evil, the market wants to take my money. The market is an amoral entity, right? It's not evil, it's not good, it doesn't care. But you have to come at it from this perspective just to save yourself a lot of pain. And it was apparent to me that the market was looking to trap bulls. I just expected one last move to the upside on Friday, and I expected this massive sell-off to come Monday. But as it turns out, the market had amnesia, and suddenly it was reminded by the Fed that, oh, interest rates are moving up, the economy is slowing down, and there is pain to come. Well, apparently the market forgot all about that as we were moving up. Just goes to show how dumb market participants tend to be. And this is the reality. A lot of money in the market is what is called dumb money. Okay? It's dumb money. It pours into the market at the top and it sells at the bottom. That's dumb money. You want to be buying at the bottom and selling at the top. So why was it apparent to me and several other traders? It wasn't just me, right? Several other traders were warning that a crash was coming off of Jackson Hole. And it was apparent to me for one major reason. And it's greed. The market was greedy. The market was moving up, even though the Fed was tightening monetary policy. The market simply ignored the Fed on its way to the upside. It just ignored the Fed. And it needed a sober reminder: don't fight the Fed. Just don't fight the Fed. There's no winning in fighting the Fed. When the Fed is loosening policy, you want to be buying. And when the Fed is tightening policy, you want to be selling. Because essentially, guys, the way the Fed tightens policy is by dumping financial assets. They dump bonds. And when they're loosening financial conditions, they're buying financial assets. They're buying bonds. And recently they've been buying mortgage-backed securities. And that money flow into bonds also feeds into equities, into stocks. And it's for a very simple reason. When the Fed buys a lot of bonds, the yields on those bonds decline. So the profit, the yield, the coupon that you get from holding those bonds goes down. And when the yield on this asset, on bonds, decline, stocks suddenly become way more attractive and money flows out of bonds into stocks. So that's essentially what has been happening for nearly 2 decades now, but more so since quantitative easing in 2008. And so even though the message from the Fed really never changed on the way up, it was really always the same. The Fed was tightening, they were fighting inflation, they were raising rates, the message was the same. The market simply chose to ignore that message because of greed. That's really what it comes down to. The market ignored the message because it got too greedy. The market was actually hoping that the Fed was going to continue to raise rates until the end of the year and cut those rates back down early next year. Now, this assumption was based on nothing. There was no real basis for this assumption, but this assumption is what drove the rally in the market. Market participants simply did not want to miss on an upcoming easing cycle, and so they piled back into the market prematurely, and now they're suffering the consequences. Now, if you've been following this channel, this is a new channel. I've only started to upload about a couple of months ago, but if you've been following this channel, I've been talking a lot about this, and it's really not rocket science. So what's going to happen now? Well, let's take a look at a few technical signals. First off, let's take a look at this absolutely massive move to the downside. I just want to go back and look at the last time we saw a red candle this large, okay? And it wasn't back here in June. I would have to go back to May, not even May, right? This candle is still smaller. Maybe back here in early May. Oh no, I would have to go all the way back to March to find a candle that is even close to the size of this red candle. And so what's going to happen from here? Well, first off, the options market is pricing the weekly expected move about $10 in each direction. So the weekly expected move for next week is $394 on the downside and 416 on the upside. This last week, guys, the weekly expected move was actually at $413. We hit that weekly expected move on the very first day of trading. And I did say on Monday that when that happens, we tend to see a mid-week bounce back. That's exactly what we had. And in the last day of trading, we broke below the weekly expected move. It does happen sometimes. The market does go out of the range of the weekly expected move sometimes, often 68% of the time. The market trades within the weekly expected move, but 32% of the time it doesn't. Okay, and when that happens, when it trades outside of the weekly expected move, we see a massive spike in volatility. We see selling into selling into selling, okay? And to be completely frank, there's a chance that this happens again next week. So what are the levels that we're looking at? Well, between $405 all the way to $390, there's really no real support. And why is that? I've been talking about the $390 level for a long while now, and it's for a very good reason. It acted as support back in May, very strong support. Once we broke through it, it acted as resistance, and once we broke through it again, we retested that level before moving back up. So it's very clear from the market action that this is a pivotal key zone, and my personal expectation is that we will see this level getting hit in September. After we hit this level, it is reasonable to assume that the market will try to rally again. At that point, watch for a failure of that rally. If that rally fails, again, we have another key level right here at $378 to close this gap. Again, if this level fails, we have one last gap at $366. And this is a good time to reference this chart. Again, this chart is from Chiovaco Capital. I did cover this chart in last week's roundup video. This chart, guys, looks at the maximum drawdowns after this signal is triggered. When 90% of the S&P 500 stocks close above their 50-day moving average after the market had already declined by more than 20%. So we had the market decline by more than 20%. We bottomed in June. We had a bottom in June. And since then, the market continued to rally, and it reached a point in market breadth where 90% of the S&P 500 components closed above their 50-day moving average. And so this data, guys, looks at all the times in the past going back to 1942. When that happened, we looked at the maximum drawdowns. Now, again, if you go back to that video, you will also hear me say that I do not expect the market to have a shallow pullback. I expect the market to have a pullback that is similar to the worst case scenario. And that's pretty much exactly what ended up happening. We closed below $410. This cluster of potential pullbacks ends at 4,100 on the SPX, 410 on the SPY ETF, and we have two more additional possible drawdowns based on the historical data. This is just historical data, guys. It merely speaks to the odds. It doesn't mean that this is the worst case scenario. We could still see a break below the June lows. That is still possible. It is also possible that we see a shallower pullback and we do not go beyond 3,800 on the SPX. So this just speaks to odds. It's not a forecast in any way, shape, or form. One other chart that I did reference, guys, is seasonality. Again, I've been talking about this for 2 weeks. I've been saying that we've always had a sharp sell-off towards the last week of August into September, right? I've been saying this since mid-August. I've been saying that every single midterm year, we've seen a significant sell-off towards the end of August, early September. And this year is a midterm year, and this chart looks at seasonality of midterm years. We're still in the midst of this sell-off. Again, I expect at least a touch of the $390 level. At that point, we'll start to reassess again and look at possible failures in market bounces. If we see a bounce off this level and a failure after that, again, we will be watching for a reconnect to the $378 level to close this gap. Now let's take a look at the triple Qs. The triple Qs had an even worse sell-off than the S&P. And this is very typical because the triple Qs, the NASDAQ, has a heavier weighting of tech and communication services stocks. And those stocks tend to be riskier than the rest of the market, than the S&P 500. And so when the market moves up, the NASDAQ outperforms. And when the market sees a sell-off, the NASDAQ underperforms the S&P. Now, critically, guys, we do have this support line coming in very close. We also have the 50-day moving average, this green slope right here. Watch for a break below the 50-day moving average and or a break below this support line. If we see that, guys, if we see that, the NASDAQ's, the triple Q's outperformance of the S&P on the way up will turn into underperformance on the way down, meaning the triple Q's, the NASDAQ, will see a more significant sell-off than the rest of the market. And at that point, guys, I'll be watching for a retest of the lows, of the June lows, and again, a fill of these same gaps that we've seen on the S&P right here on the Nasdaq. The first gap sitting at 286, another gap at 274, and again this pivot zone right here, guys, at $290. Now let's take a look at the VIX. Again, the VIX has been a beautiful indicator for us this last year. The VIX sell signal that I've been tracking has had a 100% track record of catching tops and predicting significant sell-offs. In fact, let me add the S&P 500 to this chart so you guys can see what the heck I'm talking about. And here it is, guys. The first signal was triggered in early November. The Nasdaq actually topped right around here on November 8th, I believe, and the Nasdaq was never able to reclaim the November highs, and we had that significant sell-off come in late November. The S&P actually continued to make a higher high on January the 3rd, but again, this signal caught this top, and we had a massive sell-off. The signal in February caught this top and we had that massive sell-off. The signal in early April, late March caught this top and we had a massive sell-off. Again in June, same thing really, and again in mid-August when I started to talk about the Fed's plan, Jerome Powell's plan to crash markets after Jackson Hole. Now we're seeing the VIX put in higher lows and higher highs, and is now firmly in an uptrend. This is very bad news, guys. Nothing good happens in the stock market when the VIX is climbing up and when the VIX is trading above its 50-day moving average. So be very careful here, guys. This is the type of environment where we get massive whipsaws that often resolve to the downside. Now let's take a look at our old friend, the HYG, the high yield bonds. The reason I track this product, guys, is that it can give us really valuable hints into what the S&P 500 is going to do. Remember, guys, the S&P and the junk bonds, the high yield bonds, are both considered risky assets. Okay, they're both considered risky assets, and so they trade very similarly. The difference is that bond traders tend to be much smarter than stock traders. It's a cliche saying, but it's absolutely true. And we've been using the HYG, high yield bonds, risky bonds, to catch stock market tops and sell-offs. And the way you do this, guys, is you look at divergences. And what do I mean by divergences? Well, I've marked these same periods on the S&P 500. And so I'll show you what I'm talking about. Right here, the S&P put in a slightly higher high on February the 9th in comparison to February the 2nd, basically a double top. While in the same time frame, guys, the HYG, the high risk bonds, actually put in a lower high. And so this is a negative divergence. The move in HYG, the price action in high yield bonds, did not confirm the bullishness in the S&P. And look at that. Right after that, we had that sell-off. The exact same thing happened right here in mid-April, where the S&P made a higher high, while in the exact same period, the HYG made a lower high. Okay, so that's how we track divergences, and I was looking for a divergence on this sell-off. Unfortunately, there is no divergence, right? The HYG put in a lower low. It broke these lows right here, as the S&P 500 was doing the exact same thing, breaking its prior week low. So again, stock traders and bond traders are in alignment. They're both bearish. They're both bearish on the stock market, and they're both expecting more selling to come, and so am I. Now let's take a look at the dollar index, and the reason, again, that we track the dollar index is that it moves in the inverse of the S&P. When we see a sharp movement up in the dollar index, we see a sharp movement down in the S&P. In fact, let me add the S&P 500 so you guys can see what I'm talking about. Right over here, guys, back in late May, early June, we saw a very quick movement up in the dollar index and a massive crash in the S&P. Same thing here, guys. As the dollar was moving up, the S&P was declining. Same thing here, guys. As the dollar was moving up, the S&P was topping and declining. And the inverse is also true. As the dollar index was moving down, it provided lift to stocks to move up. That's why it's very important to keep track of the dollar index. And we're now flagging, we're forming a bull flag. We haven't, surprisingly, to my surprise, we haven't seen a breakout above this bull flag, right? On a massive sell-off like we've seen, you'd expect a breakout by the dollar index. We haven't seen that yet. So just imagine how much worse the selling can get if the dollar index breaks out of this bull flag. So watch for a break out of this bull flag, guys. Watch for the dollar to take out 109 again. That would be very, very negative for the stock market. Again, look at yields, guys. I've been covering yields for weeks and weeks, calling for a head and shoulders top, right? We had the left shoulder back in May. We had the head in the middle of June, and I've been waiting for weeks and calling for a right shoulder to develop to finally have a head and shoulders top and for yields to possibly start to go back down again. And again, to my surprise, guys, after Jackson Hole, I expected yields to shoot up. They're not shooting up. They're not moving up. This is very atypical of yields. Usually when the Fed comes out hawkish and talks up raising rates, you expect the 10-year yield to move up in anticipation of future rate hikes. We haven't seen that. And unfortunately, guys, this is not a bullish development. It's simply not a bullish development. Because what it says about market psychology is that the market is so scared of an upcoming deep recession that even though the Fed is raising rates, market participants are buying bonds. That's why yields are not moving up. Because bond prices and yields are the inverse of each other. When the price of the underlying bond moves up, the yield on that bond goes down. When the price of the bond goes down, the yield moves up. And so what this tells me, guys, is that the market is very nervous, and the market, for the first time really since the middle of 2021, the market is actually now bidding up bonds. The market is buying bonds because of how nervous it has gotten. And as yields move down, guys, financial conditions loosen. They become loose for one very simple reason. When yields move down, the interest payments on your loans also move down. So it gets easier to obtain credit. It gets easier to pay down your loans. And unfortunately, that drives more people into obtaining credit, into taking out loans, and spending that money, driving inflation up. And that's exactly why loosening financial conditions threaten the central bank inflation fight. It makes the Fed's job that much harder. It means the Fed has to do that much more to bring inflation down. Take a look.
You got the tightening of policy. It's still happening. It's not over. Markets got a little bit excited about the dip in some of the inflation. They started to bite on that yield. But that we've already given up half of the yield rise that occurred, and that actually means the Fed needs to do more than if the yields had stayed up where they were, right? If the Fed takes the foot off the brake, you're going to that inflation improvement's going to go away, and they're going they're going to favor growth. Incomes are growing by 10%, but labor can only produce goods at the rate of 4%. You get a 6% inflation rate, and that's the basic. That's the first imbalance, and that's the basic cause of the inflation that we have right now. The second imbalance is the level of nominal spending in relation to bond yields. So nominal spending is even higher above bond yields than it is above output. It's 7% above bond yields. So it's the highest in 60 years. So if spending, if people's incomes are growing well beyond bond yields, it's very easy to make debt service payments. And even if you lose your job or commodity prices go up or something, you can get credit. And so the credit numbers that Ed's referring to, loans up 11%, that's a backstop on the economy and spending. So it's the high level of spending and income in relation to interest rates and labor production, and it's the availability of credit to sustain that. And that all means that you have to get a tightening of monetary policy and a sustained tightening of monetary policy to bring about an equilibrium. In an economy, there your total sources of funds is your sources for spending. And there are three sources. There's money, there's credit, and there's income, right? And so when you get to tightening of monetary policy, they're contracting money, and that's absolutely right. The first effect of a contraction in money is on asset markets. Because if you think about the printing of money by the Fed or any other central bank, they print the money and then they go buy bonds, or they print the money, and that money then goes into stocks. So that money most directly affects the financial markets. Credit more goes into spending, right? Because you take out an auto loan to buy a car, you don't take out an auto loan to buy a bond. And the Fed doesn't print money to buy a car; they print money to buy financial assets. So what you have is a push-pull where the contraction in liquidity from the central bank is a drag on the financial markets, while the expansion of credit is a support to spending. And so you got that working in both directions right now.
So in my view of it, which is a straight Milton Friedman take of it, of those three pieces that Bob pointed out, the first one is where it starts, is the money growth. I think we're pretty deep in this, and we had a pretty good drop in the stock market, to your point. And now inflation's coming down, and the markets are beginning to think that this is an introduction to the next chapter, that the next peel of the onion.
He's exactly right. So the money is the first thing, right? But and money is the first thing, but it needs to get to the second thing and the third thing to have the permanent effects, right? Which means you have to be in a tightening cycle for long enough for that to happen. It's too early to tell, really, how this plays out in terms of whether it's weak growth or high inflation or which one. But you're probably going to get some combination of weak growth, high inflation, and rising interest rates. Right. And all three of those are rough on asset prices. And the mix is going to be determined mostly by how aggressively the Fed and other central banks tighten and stay tight if they have to pay the price of a downturn.
So it sounds like an awful lot hinges on the Fed. Surprise, surprise. Jackson Hole coming up.
Right.
So how much guidance can the Fed give us about exactly where they're heading on some of the questions that Bob just talked about?
Well, it's hard to know. I do think we're going to get a financial crisis somewhere pretty soon. It's always been part of the tightening cycle.
They were clearly wrong about transitory inflation. If you actually look at the indicators that they follow, and they tend to be lagging indicators.
Do you agree with Ed that in all likelihood we'll have some sort of financial crisis, that's what happens in serious tightening cycles?
Odds are pretty good, yeah. Yeah, I mean, we haven't had enough tightening yet to really have that, but odds are good, yeah. I mean, we haven't had the downturn yet. If there's going to be a downturn, it hasn't happened yet. It's going to be hard to bring inflation down. How are you going to bring nominal spending down from 10% to 5% without a significant contraction in credit? You need to slow credit growth by about half. Money growth is slowed, but you need to slow credit growth in half, but it's still rising. You're going to have to hold interest rates up enough, and that's when bad things happen.
Now, for you guys that do not know who Bob Prince is the co-chief investment officer of Bridgewater Associates, the largest hedge fund in the entire world, and it's the largest for a very good reason. Bridgewater was actually able to beat the bear market in the first half of this year. So as everybody's been losing money, Bridgewater was actually making profits. So these guys know a thing or two about investing, right? If you don't know who Ray Dalio is, the other chief investment officer, alongside Bob Prince, he's really one of the most brilliant minds in the investment world. And he published more than his fair share of absolutely brilliant investing and economic books. Now, the second gentleman, Ed Hyman, has an equally impressive resume because he's been ranked the #1 economist for 41 years. Okay, so these guys know a thing or two about economics and investing. And when they talk, I listen. And what you've just heard them say in that video clip is sobering to say the least.